think the obvious question that I have, and I was looking at the case study for China, you beat the market in 2023 by over 100%. So the natural inclination for me as an allocator when I'm looking at this strategy, especially of how much it outperformed in emerging markets and in China, why not build a China-only strategy? So that's fascinating. You started off talking about how the models are based on economists who know how to code. The impression that I had that these were macro factors that were coming in that were giving you a sense of this regime change. Actually, it wasn't. It's actually the models were gradually percolating towards stronger companies in the deflationary environment. And we're only identifying that these were winners after the fact. Now, when we look at it from a Monday morning quarterback perspective, not knowing at the time that this is what the models were representing, but following them diligently that, okay, models are saying that some of these large names, deflationary environment, whether we knew it or not was the reason, but these are stronger companies that other firms are not looking at. And they turned out to be the big winners and therefore outperforming the market, which is fascinating. So in a way, what I'm hearing is that the models were taking a bottom-up approach that were expressing the best alpha, even though the factors that drove the weakness in the market were macro at the start, which is incredible because most fundamental managers that I know severely underperformed the market in the last 5 years. And in the last interview that I had, we talked about not fighting the Fed. And we were just talking about how even in China, you shouldn't be fighting the regulators, same thing. But what your model is able to do is still identify the shift without addressing the policy and speculating on policy shifts. That's really remarkable.
Yeah. So, I think the macro questions, even a lot of stock analysts tend to incorporate them, sometimes without being explicit about it. It's very easy to talk about these things. They're very interesting. Everyone can engage on these topics and has an opinion. However, our experience is that statistically, we have a much bigger edge at the company level than on these macro events. Even if you knew what would happen in a game of poker, if you know the other people's cards, it's easy to win. In investing, if you know what's going to happen, it's still not easy to figure out how the market will react because it's not just one event. They're counter events. And so with COVID, you had the sell-off and the lockdowns, but then there was the government intervention. And in the end, it was a great market for technology investing. Who would have thought, right? If I told you in January 2020 that there is a pandemic that's going to lock down the world and the NASDAQ will be up 40%, it's not an obvious trade. At the company level, we see which companies are holding up better than the others, again, from a gap perspective, but also based on the sentiment. And so some of these older, more boring companies suddenly were gaining investor attention. And so we slowly shifted.
Yeah, sorry, Ivan. I want to dig into this just a little bit more. When you did your, Monday morning quarterback again on how the models what was it that triggered the models to shift in the direction of moving into these more boring companies or even certain different tech companies in China in 2023, looking back and when you review the models and if you look at the weightings that were shifting towards that, what was it? Because you have so many levers. You have sentiment, you have fundamentals, you have quarterly, monthly, annual reports, disclosures. You also have alternative data. Do you have a sense, looking back, what was driving it? And surely it wasn't just,
So the indicators have to line up, right? We're looking for uncorrelated indicators, and then we rank every week. We rank the whole universe. So if you look at it across time, certain companies' financial statements will deteriorate faster than others. So they will drop down from a fundamental perspective. And sentiment, in some cases, will be even more extreme in terms of the drop. And so naturally, that's going to let other companies bubble up to the top. And it happens slowly. It's not clear. Now, it's obvious what happened. But at the time, okay, so you should get out of biotech and you should go into dental clinics. You should get hospital chains as opposed to pharmaceutical companies. And so that shift, you can go back to Japan in the 90s when they had a deflationary episode. That's exactly what worked. US in 2009, Germany in 2012, but that's only ex post when you have labeled the phenomenon. At the time, you just see these small changes. And so people inside the companies are buying the stocks, other managers who are maybe industry specialists or they are partners of these companies are buying the stock. So we see the liquidity improving in these companies. We see the price action improving together with the fundamentals holding up compared to our needs. And so that shift is in very small increments over time.
So let's touch a little bit. I think I have a follow-up question here. The way that you build your book, it's really quite diversified. You have global equities. So your universe is massive as it is. Can you just walk through the portfolio composition for me? I know you don't optimize, but on average, what does it look like in terms of number of positions, max exposure? Do you have those types of metrics you could share?
Yeah, so the portfolio is fairly static from a composition and exposure perspective. So we're always going to be around 70% net long. So it has a net long bias. And that's because over time, business leaders, government leaders, innovation push out businesses. And so you want to have some exposure to global growth. You want to hedge the downside. So we're net long around 70%. The gross long exposure is around 150%. And then we have another 7 or 80% short exposure. And that doesn't change. So in China last year, we did not profit by being short and getting that right. We were up 15% being long. In January this year, when the market crashed, we were long. Again, our shorts more than offset the damage on the long side. So we were up around 10% in January. And then when the market flipped, we maintained the same exposure and continue to benefit from the rally. And we do this in every geography. So the US is slightly over 50%. It's the largest market, the deepest market. So we have more names to play with there. Japan and China are around 7%. Taiwan is another 2. Korea is 2. Australia and Canada around 3. The UK is 5. So we have about half of the portfolios in North America, slightly over half, and then equally split between Europe and Asia for the remainder. So we like to be in as many markets.
Yeah. So you're also running roughly 700 long across 400 shorts, about over 1,000 positions in the book. Really, really diversified. And so being in global markets with 50% in the US because of DBIT makes total sense. And this is not necessarily a high frequency trading strategy. That's fair to say, right?
Yes. Yeah, our holding period tends to be a few months.
Yeah, exactly. So I think the obvious question that I have, and I was looking at the case study for China, you beat the market in 2023 by over 100%. So the natural inclination for me as an allocator when I'm looking at the strategy, especially of how much it outperformed in emerging markets and in China, why not build a China-only strategy? Increase the concentration limits and, give that punchy return that some investors are really looking for in markets that might not otherwise overlap with their existing portfolio.
We're looking into offering that on a standalone basis. So that's something that our modular approach allows us to do, and we can participate through the flagship fund. We've also done very well in India, which is at the opposite end of the market cycle and has very different dynamics. So our flagship fund has a beta of 0.5 and volatility is around 10. Sharp ratio is slightly over 1. It's designed to be a very liquid, conservative centerpiece for an endowment style portfolio. But then you could barbell this and express various views by having strategy that's something like global momentum or China or India, and combine this in different ways to offset your other exposures.
So how would that work for an offering? I mean, I'm thinking either SMA or you build a second fund, which has an optimized approach for some of the emerging markets. Would you take an SMA? And what would that size look like if an allocator were interested? Because I imagine that execution doesn't seem to be too challenging, depending on the prime broker that you're working with. Setup and idea generation is centralized at your team's level anyway. Yeah, what do you think?
Yeah, we have a number of live conversations about both options, and they could be a replica of what we do in the fund, or they can be modified in various ways, depending if it's an SMA, depending on who the asset owner is. We can change the leverage, the beta, the concentration. And so I think the blueprint for funds is the 1940 Act signed by President Roosevelt in the wake of the Great Depression. And a lot of it is about people pulling their capital because accounting, other analog activities were very expensive. The future where these things can be automated, I think, is going to be a very large infinite number of highly customized portfolios that the cost of tweaking them to solve people's particular problems is very, very low. And that's something that I think is slowly accelerating. But 10 years from now, I think it's going to be mostly accounts, which we can manage without any marginal cost.
Yeah, on a side note, I think there's something too that we are seeing less and less newly established traditional funds being set up in Asia in particular. I think Prequin had quoted newly established manager funds in 2023 was only 19 versus 2021 was 55. And so if that trend, even post-COVID, continues to persist, wow, I mean, the lifespan, or at least new funds, is almost like the birth rate in Asia right now, right? It's like halving every year. But in the wake of that, you have increasing number of SMAs, and we're seeing more and more managers being friendly to the idea of SMAs. On the flip side, you still need investors who are comfortable with having that set up and actually being partly responsible for some of the risk management as well.
Yeah. So when I think about all the technology that's coming on board, it has two main fundamental benefits. One is being able to keep up with all the information that's coming our way and is overwhelming to humans. So if you want to do value investing and doing it the old way, you're going to struggle. So the technology will help you to do value investing the way it's meant to be, but be successful in the informational environment that we operate in today. At the same time, you can put this into a fund, which is the old approach. So then I have to come and sell you this fund and say, look, you need to buy this fund. As opposed to then using the same technology and saying, look, I have this technology that can generate an uncorrelated return stream. What is your problem? Let me solve your problem, as opposed to convincing you that you need to buy this fund now. And then I can create something that is much more tightly linked to your particular needs and then run that for you. And for another person, it will be a modification of that. So we think of the flagship as the ultimate portfolio from the perspective of the people who built it. Other people are going to have different needs, beliefs, and requirements. And so you can then modify this in an infinite number of ways.
Yeah. Well, on that note, I think I'll wrap it up. But thank you so much, Ivan. This has been a fascinating discussion. And congratulations on a very, very strong last few years. And we're looking forward to seeing more of you on the street. And we'll catch up soon.
Thanks, Ivan. All the best.